Is Apple stock, AAPL, the next big short? Well, looking at Michael Burry's first quarter 2022 portfolio update, you can see his largest bet by nominal value is actually an option, a put against Apple stock. In this video, we're going to talk about Michael Burry's track record, his hits and misses as an investor, and we're also going to talk about Apple's valuation. Where do I think Apple stock can potentially go from here, and what are maybe some of the risks that sort of got Michael Burry's attention? What's the dynamic for why he's actually betting against Apple? So maybe what are some of the things that he's seeing? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no hype, mission focused channel trying to find you exceptional companies and unrivaled investments. So leave the hype at the door. Let's dive in to understand Michael Burry in a little bit greater detail and why I personally think he's one of the greatest investors of all time, which is a little bit of a conflict for me because I think Warren Buffett, one of the greatest investor of all time, Michael Burry, and they both have positions on Apple, one going the other way. Buffett has made a lot of money, though, billions of dollars on it. And so Michael Burry, this is a relatively new position for him. So what does Michael Burry see now? And what's his track record? So looking into this, you can see that, yes, he did have some misses. For example, he bet against Tesla, and that did not work out for him. And so a lot of people, have called that out, and he did get out of it. But he also did call the great financial crisis. And before then, during the dot-com bubble, as profiled in Michael Lewis's Big Short, he crushed it when the dot-com bubble blew up. So in his first year running a hedge fund in 2001, the S&P was down 12%. He was up 55%. Next year, S&P down 22%. Once again, up 16%. Oops. And then the third year, S&P was up 29%. Once again, crushed it with a 50% return. And so investors might be wondering, well, how did he even do that, in the first place? And he is a very, very deep value investor. So he's looking for things that might trade below free cash flow. He might be looking for things that are really cash generative, that trade at, let's say, a fair multiple. So he's looking at, he's a deep value oriented investor. And so I like seeing it through the lens in which he does things, in terms of what he's betting. And he's looking for asymmetric bets, like with the great financial crisis. And so not only has he done extremely well with his own hedge fund previously, but he also called effectively out how ARK had tremendous downside. And, effectively saying, yeah. And I made a video about his call literally within a couple percent of the all-time high for ARK. And since then, it's down about 70%. So you can check out that video. I personally think that Michael Burry nailed it. So what does he see betting against Apple stock? I think there's a couple of things here. So first, I actually did a video on this before Michael Burry even got involved, betting against Apple stock. I called it out, effectively warning, hey, there's a couple of data points here. This was back in December, I believe, last year, saying, hey, there's a couple of things that Apple investors should be mindful of. There's a couple of risks. And I think since then, it's gotten a little worse and a little better. So one of the things that's gotten slightly better is the valuation. And as I called out in that video, the valuation did expand significantly from a low teens earnings multiple to around 30 times earnings multiple. So when you have that multiple expansion, that could be something that's tough for them to sort of digest in the years ahead. Now, as earnings has grown and, the stock price is off a bit, their earnings multiple for the next 12 months is closer to 24 times. But if there's, let's say, a recession, or if sentiment changes and it goes back down to where it was in the low teens, this could be a major headwind for Apple stock. Another core aspect is challenges with production. There's been headlines across the board about, oh, they had to cut production here, they're having trouble with their supply chain. They even called this out on their most recent conference call, saying, yeah, our year-over-year performance in June will be impacted by a number of factors. Supply constraints caused by COVID-related disruptions and industry-wide silicon shortages are impacting our ability to meet customer demand for our products. Talk about an impact of $4 to $8 billion. They also see impact on customer demand in China with their zero COVID policies and lockdown. They're also looking at US dollar appreciation impacting their business for all their foreign business of around a 3% headwind. They also are expecting gross margins to potentially go lower year over year. We're going to talk about this margin, issue potentially for them later in this video. Another key aspect that I think Michael Burry is considering, not only with valuation expansion and potential margin pressure, is the reality is that the U.S. income, U.S. consumer, their real disposable income has actually been declining recently. And this is a big red flag that folks need to consider. Okay, so what is real disposable income? So you have wages go up over time. But if your wages go up like this and inflation is even higher, then your actual real income went down. And so that's a really tricky thing for folks to understand. So you always need to consider what's real. And so you look at the history of real disposable personal income over the last few years, steadily trending higher. That's what you want to see. COVID hits, craziness happens. You have stimulus checks. You have, Federal Reserve effectively getting in the game, lowering interest rates. You have a whole bunch of things that causes this just to go absolutely bananas. But now with inflation kicking in, partly because the stimulus was so much and wages aren't keeping up. Wages are going up, but they're not keeping up with inflation. And keep in mind, that's a government adjusted inflation that I think is sort of phony baloney. What you're looking at here is a decline in real consumer, effectively purchasing power, real disposable income, and that should have an effect on whether or not consumers can make that next iPhone purchase. And so the question is, what is the value of Apple stock from here? Where do we think it's going to go? First, a quick plug, where if you're either struggling with this current investment environment, where you're just trying to protect your savings, finding things that you can comfortably own, potentially through a full recession, maybe that's what you're looking for. Or if you want to find potential multi-baggers, the types of stocks that could potentially go up hundreds or even thousands of percent over time, go to unrivaledinvesting.com. And a big thank you to all the Unrivaled Investing subscribers that keep this channel going. This channel would not exist without the Unrivaled Investing subscribers. So a big thank you. So let's go a little bit further into our understanding. Also a disclaimer, which you can read on your own time. This is not financial advice. But I think one warning for Apple shareholders as we think about their valuation is the fact that their market share, it's not clear that they've been taking market share, that they've been winning. Yes, they've been growing, but are competitors effectively taking share? And this is in the US, effectively showing that, is it possible Samsung and Lenovo, that Android's taking market share? That would be something I'd want to learn a lot. I'd want to have a stronger view on if I was an Apple shareholder. Now management does effectively say, yeah, don't worry about it. Our installed base has effectively grown to all-time highs. We have 825 million paid subscriptions across the services on our platform. So they're saying, yeah, we're rock solid. Don't worry about these figures. But it is something I'd want to track. If I notice that market share all of a sudden dropped significantly below 50%, I'd say, okay, something's going on here. Now look at their financials. And this is how you think about valuing this business. You look at 2019, their September 2019, their fiscal year, 55 billion in net income. Next year, 57 billion. Then the following year, 95 billion in net income. This is a combination of a hot economy and the biggest driver being their new iPhone model launches. So that's just an incredible step up in their earnings power. You look at more recently, they've continued having high teens growth in their net income, 59 billion for the first half of the year. So on track to potentially being at 120 billion in earnings this next year, around 10% growth. And looking at their free cash flow, they generate tremendous free cash flow, around 60 billion 2 years ago, closer to 90 billion just last year, or a little over 90 billion. So just tremendous cash cow. And so as you think about a business, you're going to say, okay, so this is a company generating 60 to 90 billion. Maybe it's closer to 90 billion going forward, 90 billion plus pricing power, plus selling additional, services, products, watches, phones. And you're thinking about this and saying maybe that 90 billion grows. And so you want to think just high level before going into that valuation framework. I was sort of showing some of the key data points where you might want to say, well, what's the earnings power for this business? How are we supposed to think about that free cash flow? How would you think if you have 90 billion and you wanted a 5% yield for that, what would be that value? So you'd say, okay, 90 billion times 20 times multiple, that's maybe the right value. And so that's the way to think about this, in my opinion. And so let's go into thinking about this hypothetical valuation framework. Of course, this is a hypothetical framework. Stock price can go way higher, way lower. Depends on execution by Tim Apple and market sentiment. Tim Cook, obviously. And so currently around $2.4 trillion market value. And the question is, what does it grow like this next year? I'm saying 6 to 12% growth this next year. That's a range, given that they're currently growing around 10%. Where do their margins shake up? Because currently around 30%, but a few years ago it was around 24%. And management's also talking about this next quarter, our margins might start going down. So is it possible longer term that they actually reset to where they were, around closer to 26%, percent or 24%, or is 30% the new normal? So if I'm a bull on Apple stock, I would need to have a strong opinion here. So then the question is, well, what's your growth rate over the ensuing years? Maybe 6 to 12%. I'm assuming around 16% tax rate, which is what management says. So you can see it's trading around a 20s, times earnings multiple, like I already talked about. So you assume some sort of, single digit to low teens growth rate. If you're a mega bull, maybe you assume it's higher. Now, the question is, if you're in a recession, let's say in the next year or two, which is an increasing risk, then could you get a valuation multiple that's similar to where it was a few years ago? Similarly, if you have that margin compression, like where margins were 2 years ago, is it possible you just have a dramatic reset in this in effectively the stock price? And I think that is what Michael Burry's looking at, is sort of saying there's this asymmetry where if you have inflation like he knows we're seeing, and he sees the consumers under pressure like he knows we're seeing, is it possible you get a quarter or two or a year or two where Apple's results don't deliver and they're not as good? And that's sort of the short-term sort of trade, I think, that he's looking at here, where if that plays out and sentiment sort of gets squeezed with this inflation angle, could you get a much lower Apple share price, in which case the risk reward for Apple stock might not be that compelling. Now, they are just a tremendous cash cow. As I already called out, around $100 billion in cash and free cash flow this year, potentially. And they're going to be using a ton of that to buy back stock. And so that does certainly prevent you from just losing crazy amounts of money. That is a bid on the stock. And so I personally think, maybe he's penciling out 30, 40% declines versus 100% upside. Now that's not crazy risk reward. It's still favorable for shareholders. But I personally think this is the reason why, is it's not a crazy compelling upside downside. Where in my upside case, I'm effectively saying, yeah, that valuation effectively stays where it is. And maybe, they're able to sustain 30% profit margins in the future. Now I'm going to talk a little bit more about Apple, where here it is. Yes, this is probably a trade for Michael Burry, and it wouldn't surprise me to see him blow out of it in the next quarter or two. But is this the next big short? I do not think Apple is the next big short. I think it might be a profitable short trade for Michael Burry because of the dynamics we just talked about. But I'm looking at unless the competitive dynamics changes and they really are losing share, then it isn't the big short. If they really are losing share, then it is potentially a big short. But I'm looking at them saying, they have huge free cash flow. They have products that people love, and they will likely pay up for them in a few years from now. When they want to get, I want to get the new iPhone, or I want to get the latest, product for them. And it's very likely Apple's spending tens of billions of dollars on potentially revolutionary products that have yet to be introduced to the marketplace. AR, VR, car, who knows? And that is sort of optionality that's not even baked into that valuation. Now, so I look at this and I'm going, this isn't right for my personal journey, either on the long side or the short side. I think, Warren Buffett has clearly done extremely well with Apple stock. That said, I think the returns over, let's say, the next 5 years might not be as compelling as what it previously did, where he made a ton of money. I think he made like 5x. In like 5 years, just a tremendous return. So I am more interested in maybe some of those deep value plays. And so later this week for Unrivaled Investing subscribers, I'll go through maybe some of Michael Burry's other holdings that honestly a lot of YouTube folks might not even be interested in. They want to, they're interested in, hey, what's the big companies out there, or how's my portfolio doing? And so later this week for Unrivaled Investing subscribers, I'll maybe go through some of this, hidden treasure that Michael Burry might be finding, in these deep value potential names. Maybe it's a company that's declining but trades below assets, or trades at like 3 times free cash flow. We'll talk about that dynamic later. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.